Hey, good morning, everyone.
Good
Good
morning,
morning,
sir.
sir.
Let's just wait for another minute and then we can just quickly start the class. Okay, guys, so welcome to today's class. We'll start. It's already 9:33 at my place. So I believe my screen is visible to you guys.
Yes, sir. Visible.
Yes. So thank you for confirmation. So in the last class, we discussed about the variance analysis, right? So we had a discussion on the budget, a brief discussion on budget. Then we moved slowly on to how the variance calculation needs to be done. Okay. So today what we'll do is we'll solve a question on a variance analysis, like a full-fledged question which covers your direct material, direct labor, your variance, and your fixed overheads and sales variance as well. So let's do a quick question on that so that we are familiar with the variances and the formulas as well. And in the next session, like the second half of it, we will probably move on to the marginal costing and how this marginal costing with respect to contribution margin and fixed cost basically works. So we'll have a brief discussion on that.
Hi, Ajinkya. Sorry to interrupt.
Yeah.
Hello?
Yeah, tell me,
Yeah,
Shreya.
Tantra is joining. Okay. I
Okay.
just called. She's joining.
All right. No worries. Thank you, Shreya, for confirmation.
Yeah. I don't know why today is only, I'm able to see only 4 students has joined because they are getting the recording. I think they are not joining the live session. So you better tell them that, it's not the way like they are not joining and only get the recording. Henceforth, then we will not share the recording in that case. I will also inform in the WhatsApp group. You also tell them.
Thank you. Great.
Yeah.
Thank you.
Okay.
Thank you. Okay. So this is the question for variance analysis. It's kind of a very basic thing, but it's kind of a very good question to understand all the concepts. So if you want to take a quick screenshot of it, you can have a screenshot on your phone or somewhere, or you can just write the information down. I would be sharing the question in the group, but after we solve it. So what I'll recommend is that you just take a screenshot as of now, and so that we can quickly refer to the questions. Okay. All right. Okay. So it says a manufacturing company ABC Limited has provided the following data, following standard and actual data for the production of 1000 units for its product for the month of June. We have got standard data with respect to materials, labor, variable overheads, fixed overheads, and selling price. In the last class, we discussed until labor variances, right? We didn't touch on variable, we didn't touch on fixed overhead, and we didn't touch on the the selling prices of it. Okay. So along with this question, we'll touch base on these three aspects, and we can move forward that way. So we have given the standard data directly. So 2 kg per unit is required at the rate of $5 per kg, 3 hours per unit at the rate of 20 per hour. Then we have got variable overheads, 3 hours per unit at the rate of $8 per hour. Same goes for fixed overheads. So fixed overheads as per standard are 15,000 based on an activity level of 1,000 hours. So if you remember, in the last class, we discussed that the variable overhead and the fixed overhead would always have a base. It could be units, it could be liters, it could be hours. So in this case, the variable overheads and fixed overheads are getting distributed, are getting allocated on the basis of hours. Will it always be hours? No. It could be anything. It could be liters, it could be units. It depends on how the company wants to calculate it. But as a general practice, it is always hours. Even if you want to apply the variable overheads and fixed overheads concepts in practical life, you would have the hours as kind of a major allocable factor. And then we have got selling prices, which is $100 per unit. Then we have got actual data as well, which says units produced and sold is 1,000, direct material used 2,200 kgs at the rate of 4.80. Then direct labor 3,200 hours at 21 hours, $21 per hour. Variable overheads, we directly have the actual data. Fixed overheads, we have the actual data. Total sales revenue, we have the actual figures. And what it says is it just tells you to calculate all the variances. So this question is kind of a base to formulate and to make yourself familiar with how this variance analysis as a whole is going to work. There's a high probability that if you're doing a CMA, this would be asked in your essay type questions, the one wherein you have to give your opinions and all. So the question usually will ask you to provide a certain calculation initially based on the data which it has provided, and then it will ask you for your recommendations. So I'll tell you how uh, that answer you need to give. So we'll have a look on that as well. So let's quickly start this question basically. So it says to calculate all the variances. So let's start with the first variance, which is material variance. So in a material variance, it is divided into two parts. The first one was the price and the other one was the usage. We are not going into the other category, which is the mix and the yield. We'll keep it simple as of now. We'll just keep it to the first level. Just give me a moment, guys, okay? Antara, are you there, Antara? Are you the new student? So Antara, what I'll request you, oh yeah, you're putting in the message. I'll just request you to stay back for like 10 minutes after the class so we can have a quick discussion uh on the things, okay? If that's okay for you. All right. Yeah. So sorry for the interruption, guys. So the material variance is basically the first one is the material variance, and in the material variance, the first sub variance is basically the price. There was some kind of a distinction. Yeah. So the first variance is basically the price variance, which says the standard price minus the actual price, and then it needs to be multiplied by the actual quantity, right? So let's check, do we have the actual price with us and the standard price? So the standard price given to us in the question is $5 and the actual price is 4.8. So this becomes 5, this becomes 4.8, and then you need to multiply it by the actual quantity. What is the actual quantity? Actual quantity produced or actual quantity consumed. Okay, so there are two things into it. So by default, the formula always focuses on the actual quantity produced. So by default, the formula always has this kind of a parameter for a multiplication. But if in case the question tells you that, look, we need a price variance based on the consumption. So then you need one more category which says units consumed. And then whatever figure is here, you need to use those units for the multiplication. The actual quantity produced is actual quantity of materials used. Yeah, this one. If you see, this is units, means this is the finished product. Because we are dealing with material, we need the kgs. We're dealing with this, we need the material used, which is 2200 kgs. So this bracket, there's a bracket basically right here. So it's like this. And then you multiply it by 2200. So it's 5. That was my standard price. 4.8 is my actual price. So what happened was I decided at the beginning of my budget that the price which I'm going to pay to the supplier is $5. But at the end of the year or at the end of the quarter, at the end of the month, I ended up paying 4.8. So I decided to pay 5. I ended up paying 4.8. So what it does is it basically saves my 0.2 on every quantity I have consumed or produced of the materials. So it would be 0.20 multiplied by 2200. That is going to give you an answer of your price variance. It could be 5 minus 4.80, and then you multiply it by 2200. And this would be your final answer. Now the question is this favorable or unfavorable? So just try to interpret it, because don't just be dependent upon the signs of it. So you started with 5, you ended up paying 4.8. So that is a saving for you. This would be a favorable variance. This is a favorable variance. The next variance is now the usage variance. Usage variance. So it would be standard price. So it was standard price earlier. If we use the same concept which we discussed in the last class, it would be standard quantity minus the actual quantity. And there was one concept which we discussed in the last class, that once the price variance gets separated, all the things are multiplied by the standard price. Once your price variance is separated, all the multiplications are to be done by the standard price. If it is labor, it would be standard rate. So what is the standard quantity now, which was expected? Can anybody just tell me what kind of a standard quantity we are expecting? So you have these figures in place. We want the standard quantity. What is the standard quantity of the materials which we have decided in our budget? Anyone? So this information would probably be the one which is going to give you a bit of a trouble when you are going to solve the question. So you produced 1000 units.
2000.
Yes, 2000. That is correct. That is correct. Can you just help us? How do you calculate that?
Standard quantity
Yes.
is equal to
Yes.
standard quantity per unit into actual units produced.
Correct. Correct. That is absolutely correct. So whenever
2
you say
into
standard,
100.
yes, that is correct. Whenever you say standard quantity, it's standard quantity for actual output. So just remember the standard quantity is always with respect to actual output. So the actual output or the actual output is an actual finished product. So actual finished product is 1000 units. So you basically ended up producing a finished product of 1000 units and you required 2 kg per unit of your direct material. So that basically makes it 2000. So standard quantity required is 2 kgs per unit and you ended up producing 1000 units. Sorry, 1000 units. So if you just do a cross multiplication, you'll get 2000 units as your standard quantity. So just remember, this is something which you need to double check whenever you're solving the question. There is a high chance that it would be given in the question sometimes. And there is also a probability that it won't be given to you in the question. So it depends. You need to just read the question again and again just to make sure that your standard quantity, which you're using in the question, is correct. So standard quantity would be 2000 units. Actual quantity. What is the actual quantity used? Yes, so actual quantity used is 2200. Because you're analyzing the material part of it, the quantity which you need to use or the parameter of the quantity which you need to use would always be kgs, because that's the one which the question is referring to every time. So you cannot use units as your parameter because that's for finished product. There's a difference between units and finished products. So if the units are given to you in the question, it is probably referring to the final product, and that final product uses direct material, direct labor, direct overheads, and fixed overheads. This would be 2000. Then you minus the actual quantity which you use, which is 2200. And as we have decided that once the price variance gets separated, all the things have to be multiplied by standard price. So the standard price is 5. And then this would be your answer. So it would be 2000 units, sorry, 2000 kgs minus 2200. Then you multiply it by 5. So this is going to give you an answer. So it says 1000 negative. Let's just ignore the sign and just let's try to interpret this, which says, as per your budget, you decided that 2000 would be the 2000 kgs would be the material which you need. But then what happened actually, you ended up having 2200. So you spend more of the materials than what you were estimated of. And that's why this becomes an unfavorable variance for you. Okay. So if I want to calculate a total variance of material, it would be 400 favorable and 1000 unfavorable, making it 600 unfavorable. So this would be your like the total of the variance. So there was a difference between your budgeted costs and your actual cost. And for material, you ended up having 600 of unfavorable variance, which means that you spent 600 more than what you expected. Then moving on to the labor variance. So instead of price, there is no price for the labor, there is a rate for the labor. So there is a rate. So you just need to replace price by rate. Then there is no standard price. We always have standard rate. And there is nothing called actual price. It would be actual rate. And then instead of having actual quantity, this would be actual hours. So if you check out, so the standard rate, the standard rate for the labor, which is given to you, is 20 per hour. So every hour you pay $20 to the labor. That is your standard rate. So that would be 20. So what was the actual rate you paid? So you paid 21 labor hours, like 21 hours to your laborers. This would be 21. And then what are the actual hours? How many hours did you actually work? So you ultimately worked for 3,200 hours. So again, this would be 20 minus 21 multiplied by 3,200. Of course, there is a bracket in between. There's a bracket in between. And that gives you a negative variance of 3,200. So what it means, you decided at a labor rate of $20 per hour in your budget, and you ended up paying 21. So there was a difference of $1 every hour. And that is basically hampering your pocket. So if you observe one thing, if you are always subtracting standard minus actual, if you're always doing a standard minus actual, so if you're using this formula, the negatives are always your unfavorable variances, and the positive would always be your favorable variances. There would be certain questions wherein if there is a kind of a missing information in the question, wherein you need to calculate it, the question would always say that it would be a favorable or unfavorable variance. So what I mean by that is, what the question is going to tell you is, for example, the usage variance is 1,000 unfavorable, and the price variance is 440. Oh, I'm so sorry for this. So this should be 560. Okay. So it will always give you this information without the signs. That's why it is important for you to interpret it. Sometimes what is going to happen is, in your MCQ questions, there would be a different parameter which the company is using to calculate variances. Can the company use it? Yes, the company can have their own parameters to calculate the variances. So the formula to a certain extent would be given to you in the question. And then instead of the mathematical signs, it would be reflecting as the favorable part and unfavorable part. So you need to make sure that whenever you're inputting this values into the formula which the company is using, you always try to interpret it. Because without interpretation, the formula is going to go wrong ultimately. So just don't be dependent on science, but you can be dependent on science when you always have standard first and actual later. So if you're using standard minus actual, always, you can trust on the science. But then this formula could be written in a different way as well. So for example, if a company follows a practice to define actuals first and then compare it with standards, this is going to happen now. The actual rate minus the standard rate, then you multiply it by the actual hours, right? The actual rate is 21 minus the standard rate, which is 20. Then you multiply it by the actual hours, which is 3200. Now what is going to happen? The answer which is going to come, this would be 3200 positive. And if you are just depending upon the sign of it, you will put this as favorable variance. And that is something which is going to be incorrect. Again, if you want to interpret it, you can interpret it that way. Your actual rate was 21, but you decided to pay 20. So why did you pay more? So this becomes your, again, unfavorable variance. That's what my point is. It doesn't depend upon the sign directly. So just make sure that you have this in mind. If you are sign conscious, you always use standard first. Standard should be first if you're sign conscious. If you are just interpreting it logically, whatever the formula is, the moment you start interpreting it, the sign doesn't matter for you. Okay. Let's go to the next one. It says labor usage variance, which is also called as the labor usage or the labor efficiency variance, because it's kind of not fair to use the term usage for labor. It's better to use efficiency word for labor. So this would be standard quantity. Instead of standard quantity, it would be standard hours, actual hours. And as we decided earlier, once the rate variance is separated, all the things are need to be multiplied by the standard rate. So now the standard hours. So again, that is something which you need to again calculate. So can you calculate the standard hours?
Sir, 3 hours into 100. Sorry, 1,000.
3 hours,
3,000.
that's the rate as per, that's the standard we decided for one
Yes,
unit, and you ended up producing 1000 units.
1,000 units.
So for every one unit, you're spending 3 hours. So that is your standard kind of a formula which you have already defined. So 3 hours into 1000. So it's going to give you 3000 units. Oh, sorry, 3000 hours. But what happened in reality, you ended up spending 3200 hours. So look, so this is something which is now giving you a headache. Why is it happening? That why your estimates are going wrong? So there has to be a reason for it. So the first thing which you need to calculate is the variance, and then you need to do like an analysis on it as to why this has happened. So 3000 was your standard rate. You ended up paying, like you ended up working 3200 hours. The standard rate which is given to you for every hour which you decided was 20. And now this would be 3000 minus 3200 multiplied by 20 is going to give you an answer. This would be 4000. And because we are doing standard minus actual, we can rely on the sign and we can put it as unfavorable. You can always do 3200 minus 3000 multiplied by 20, and still this answer could be unfavorable. So in that case, we'll just start interpreting it. So either way, whatever you feel is best for you. This becomes a total of unfavorable variance of labor. So if you want to compare it, so let's do a quick interpretation here, because that is something which we need. So the material variance was unfavorable by 560. Cool. The labor variance was also unfavorable by 7200. So overall, when you prepared a budget and whatever estimates you made, those estimates with respect to both the categories, that is the labor and the materials, they are basically out of place. So now what you as a CMA or as an FMAA expert or an expert as in general or as a management consultant, what you should do is you should go deep into analyzing this and asking the questions as to why was our interpretation wrong. So can anybody just take a random guess as to why my usage was kind of against my estimates? Does anybody have any idea as to why it could happen? Any random guesses, guys? Like what happened that I ended up using 2200 when I decided that I am only going to use 2000 units. What would have happened? What could be the probable reasons for that? These reasons would be asked to you in your essay type questions. So what they'll tell you is they'll tell you to, first of all, the first part would be to calculate. So calculation would be a kind of the same level which we are doing right now. Not too much complicated, not too much simple, just a kind of knowledge testing concept. But then the full focus of that essay type question would be on the reasons you put in. So you should always be familiar with what kind of the reasons are there for a negative material usage variance. Can anybody give me a random guess? Or just a random guess? We can have a quick discussion on that. No, nobody has an idea on that. What happened that I had to use more material? What happened that I had to consume more material? What was that reason? What could be the reasons? Could it be wastage? There's a lot of wastage this time. So you estimated a wastage of 10% and you arrived at the standard quantity in total. But then what happened was there was a lot of wastage. Why there was a lot of wastage? Because there was torrential rain coming in, unprecedented rains happened, and your stock was like uncovered. It was kept outside your warehouse in open, and it got basically destroyed by the rain or the thunderstorm and all those things. So the second, so what I'll recommend is whenever you do an analysis for variance, just try to find out five kind of reasons for it. What do you call it? A 5 eye analysis.
Sir, like quality issue.
Like, as in?
Quality issue.
Yes, there could be quality issues, correct? So there could be the second reason could be the quality issues.
Yes, sir.
The quality which you got, I mean the quality which you expected as per the standard or as per from your supplier was at an extreme level, but then ultimately what happened was because you got a degraded product, you had to use kind of a more actual quantity because there was a quality issue with it. So always try to find out 5 reasons. Try to find out. I mean, there could be that it would sum up in some 2 or 3 reasons as well. But then the logic should be to find out 5 important reasons as to why this happened. So
Sir,
this is called
worker error.
five. Sorry,
Worker errors. Like
worker. Yes, it could be there. Worker errors. So what do you mean by worker errors is there was a
lack of
worker who was the.
training.
Yes, go ahead. Go ahead, please. Go ahead.
So like lack of training.
Yes, there could be
Worker
lack of.
error can be happen.
Yes, yes, absolutely. So, for example, there is a machinery wherein it requires a certain input to be given, but now you have got a trainee who is basically handling that important machine. And because he's a trainee, he's not used to all the features and all those things. So that's why the machinery is getting stopped in between. There is a lot of material going in and getting wasted. All those reasons could always come into play. Now, what do you think as a management accountant? will you be analyzing this as well? The price variance. The first question is, should you be analyzing it? The second question is, how will you analyze it now? The price variance. It says standard rate was 5 and you ended up paying 4.8. As a management accountant, if there is a variance, it could either be 0, it could either be favorable, it could either be unfavorable. Come what may, every figure for the variance has to be analyzed as to why it has happened that way. So it cannot be that you only are going to analyze the unfavorable variance. This is like a very common mistake which basically the students do. They calculate the figures and they see that, okay, this is unfavorable, this is going against me. The only reason I'm going to analyze it is for the unfavorable part. No. Although this has been favorable, you need to again analyze as to why you were into the favorable side, because tomorrow this could be just like a reverse situation for you and you will ended up paying something more. So you need to have a control over it. So you must have seen that there is a post called financial controller. And what does the person do is basically the same thing which we are doing right now. So what could be the reason? So the question is, why did you anticipate it at 5 instead of when it was 4.8? So first reason could be that there was a lot of supply into the market for that raw material. So if you see this, even in India, when the prices of onions, tomatoes, or cabbages, they basically what happens is if they're not getting a proper rate, they start throwing the vegetables. Right? Why they do that is because they want the supply is too high and the demand is pretty low for that. And that's why the prices are going down continuously. So if this is a question which you have and there is $5 which you estimated, you need to question your budgetary department. So this one would be a direct question on your budgetary department as to why did you interpret or why did you estimate it to be $5. So that is a question which as a management consultant or a financial controller, you would be asking your budgeting team, what was your logic in estimating this at 5? And then once you get kind of a satisfactory answer on it, or if you want some kind of an interpretation changes, you can recommend that. So as a CMA, you would be the one who would be kind of giving your suggestions on that. Ultimately, what happened, although you had a favorable thing, you ultimately ended up paying 560. And that is kind of a out of pocket expense which you made. Same goes for your labor as well. Labor is pretty unorganized this time. So if you see 3,200, 4,000, 7,200. So you messed up in the rate, you messed up in the efficiency as well. So why was it? I need the reasons for it. Because your question in the exam is going to ask you for reasons. And trust me, the essay type questions which you have in the examination, they won't be having sufficient information for you to point out the reasons. It will tell you as to comment on the reasons, analyze on the reasons, give your inputs on the reasons, or give your inputs as a whole. So why the rate was more, why there was kind of why did you ended up paying 21 when you decided 20? This is something which you can control. Why? What happened? Okay, there was a pandemic coming in. Nobody was ready to work at $20 because you have a very shortage supply of labor. Everybody wanted a higher rate. Why it happened that a product or a finished product which required a 3,000 hours ended up having 3,200 hours. Okay, there was 200 hours of machine failure. Why? Because we are not doing maintenance properly. Why you're not doing maintenance properly? Because the maintenance contract has expired. why the maintenance contract has expired is because the administration team did not renew the contract on time. Why didn't they renew the contract on time? Is because they're lacking on staff. They require 5 people. They're currently working on 2. There is a lot of pressure there. That's why they missed to renew the contract. So that's how you need to just keep on doing like a backward analysis. And that you need to present it to the management via PPT or a kind of a statement. So as a financial consultant, management consultant, controller, budgetary controllers, that would be your primary job. And these type of jobs you should be aiming for, even once you qualify your CMA or FMAA. So moving on, we did a lot of discussion there, but then it was kind of needed. So then there is another variance which is called as overhead variance, which is called as variable overhead variance. This is something which we didn't touch, but then it's pretty organized, nothing to be worried about. So the first one is called as expenditure variance. So how much was the variable overhead expenditure you estimated versus what was the expenditure you had? So it says actual variable overheads minus the standard variable overheads. So actual variable overhead. So if you see the actual variable overheads which you have is 25,600, which are given to you in the question. So it would be 25,600. And then what is your standard variable overhead? So for standard variable overheads, what you need to do is you need to have actual hours multiplied by the standard rate of the variable overheads. So the actual hours which you have in the question is 3,200 hours. This is 3,200 hours. Then what is the standard rate which is available for the variable overheads? It is 8 per hour. And then this would be 3,200 multiplied by 8, 25,600, and the answer would be 0. So for variable overheads, basically what happened was there was no variance. But if you see why there was no variance is because, so there is one kind of an interesting fact right here. There's one kind of an interesting fact here which says, if you see these actual hours are getting reflected right here. So for example, if your actual hours were less, say for example, if this was 2,800, this would have been 2,800. And the overall figure would be a little bit less. If you see what I've done in this one is the standard, I've put it after the actuals. Can you put it the other way? Yes, you can put it the other way, which should be the case if you want to do like a sign-based analysis of it. Then there is something called as variable overhead efficiency variance. It's the same as labor, but the only difference is that the rate which you're going to use would be the variable overhead rates, not the standard overhead rates, or sorry, standard labor rates. So this would be standard hours minus actual hours, just as the labor part. See, standard hours minus actual hours, and the standard rate again. But then the standard rate would be for the labor for the variable overheads into the standard rate. So standard hours were 3,000. This was 3,200, but the rate is 8 because we need the variable overhead rate and we don't require the labor rate. So this would be 3000 minus 3200 multiplied by 8. And this is 1600 unfavorable. Or I can do what I can do, I can just put it this way. So that makes a bit more sense. It's going to make a bit more sense. The variance is 0. It's nothing for an interpretation here. The question is, can you still go deep and analyze as to why this was 0? This was 0 because the actual hours and the standard hours made a difference. And then once you have this in place, you can always go and calculate the other variances, which is fixed overhead variances. So instead of using the word standard for the fixed overhead variances, we always use a word which is called as budgeted. So the first one is fixed overhead, budgeted variance, which says we need the budgeted fixed overheads. So budgeted fixed overheads, and then you need the actual fixed overheads. So do you have the budgeted fixed overheads? Yes, we have the budgeted fixed overheads, which is 15,000. Do we have the actual fixed overheads? Yes, we have actual fixed overheads. So the difference is again unfavorable of 500. Then there is something called as fixed overhead volume variance. Volume variance, which says you need standard hours minus the budgeted hours multiplied by the fixed overhead rate. So what are the standard hours? Can anybody tell me what are the standard hours? Same way, the way you calculate it for labor, the same way you calculate for material, the same way you need to calculate it here. So there are standard hours and there are budgeted hours. Anyone? Just use the same logic you have for the one which you calculate for labor and material, and you will have the answer in place.
Sir, 3 into 100,000.
3
3,000.
into
100,000.
so you said 3 into
1,000.
so where did you bring this 1,000 from, and where did you bring this 3 from?
Unit produce already given 100,000 units.
100,000 units. Okay, that's fine.
Yes, sir.
And then this 3, where did you bring this 3 from to multiply it?
Sir, this one, variable overhead 3 hours per unit.
Okay. And then, but we are calculating for fixed overheads, right? So why did you use this rate?
Is it 15 hours?
So you did this way, 15,000 divided by 1,000, right?
Yeah.
Yeah. Okay. Anything else? Anything else, guys? Just try to rework on the calculation where you're in here, but just try to rework on Anyone? No? Can you tell me what are the budgeted hours now? So there is a difference between standard hours and budgeted hours. This is only for the fixed overhead kind of a thing. So what I mean by that is for fixed overheads, you need three things, which is budgeted overheads, you need actual overheads, and you need standard overheads. So the budgeted overheads would be the budgeted rate into the budgeted hours, actual rate into actual hours, and standard rate into standard hours. So the standard rate also called as the budgeted rate also called as the predetermined overhead rate can be calculated as the budgeted fixed overheads divided by budgeted fixed overheads divided by the budgeted fixed overheads hours. Then this is all about the rate. Then there is something called a standard hours. This we need to define as per the actual levels. This is as per the actual levels. And then there is something called as actual rate. So you had hours and you have rate. So actual rate would be actual fixed overheads divided by the actual fixed overhead hours. So now can you tell me what exactly would be the answer? So the fixed overhead rate would be 15,000 hours, $15,000 divided by 1,000. That is an activity level of hours for fixed overheads. That is going to give you an answer of $15. That is your rate. The question is, what are your standard hours and what are your budgeted hours? So for every 1 unit, how many hours do you require? It's these hours. It's 3 hours. So it's not the case that it is only given for variable overheads, it is only given for direct labor hours. No, it's only for the final product. So what you need is the standard hours for one finished product. So that is 3,000. And what are your budgeted hours now? The question is, what are your budgeted hours? So budgeted and standard is always with respect to actual. Because there is no distinction here given in the question with respect to budgeted and standard, we'll have to consider this as 3,000. That's the standard and that's the budget. And the answer would be 0. In other questions, there would be kind of a figure given to you. If not, you can just use the standard for your simpler calculations. So now the question is, the fixed overhead budget variance was $500 negative, that is unfavorable, and we didn't have the volume variance. So why was the reason as to why we ended up paying 500 more for our for the budgeted variance? Then why was the reason as our variable overhead efficiency got down by 1600? So if you want to consider the fixed assets part or the fixed variance part, there is a probability that you estimated that your fixed cost with respect to your rentals got increased. There was a sudden increase in the contract, or there was a sudden increase in the capacity which you required to kind of manufacture the things. You had an ad hoc increase in the capacity that basically for which you had to pay a more amount to get it sorted out. What happened for your variable efficiency or variable overhead efficiency variance is because your labor, if you see both of the efficiencies are negative. You see the both of the efficiencies right here are negative. And that's the reason we are using the same rate. The reasons would be more or less the same. The ones which we have for labor, there was a skill issue with the labor. There was a downtime for the labor. The machine didn't work on time because of the maintenance part and all. All these things would again come into play. But then the reasons would be probably be same or kind of similar reasons would be there. But then there's one more thing which you need to analyze here is what if the rate which you are using for the actuals would have decreased, and there could have been a different interpretation on altogether for each and every scenario. So overall, these are the variances which you guys need to be familiar with. So these are called as cost variances, wherein we are talking about the cost every time. And there is something called as sales variance. There is again a sales price variance and then sales volume variance. It basically goes in the same way as we have for material price or labor rate. It's the same logic we are putting in. But instead of having a standard price minus actual price, this time what we are going to do is we are going to put it actual price first and the standard price or the budgeted price later. And then you multiply it by actual quantity. So what is the actual selling price? So sales revenue was 102,000 and the units sold, the finished product was 1,000. So you 102,000 divided by 1,000. That basically will give you a price of 102. Sorry. What was the standard price? You already decided that you're going to sell at 100. Cool. So you decided that you need to sell the product at 100, but due to a sudden increase in the demand and shortage of the supply of a particular product, you found that there is an opportunity that you can increase your selling price. So you increase it to 102. How much was the actual quantity you sold? Actual quantity you sold was 1,000 units. So the difference of 2 on every unit would be kind of your profit or kind of in your favorable variance. Again, can this be changed or how this can be analyzed is why did we estimate this to be 100? Was there any kind of a misinterpretation which we made? And we ended up putting a lower selling price initially and ended up having a high one. There could have been a possibility that we would have estimated this to be 105 and we ended up paying 102. And this is called as surpassing the budget, intentionally putting the budgets on the lower side just to achieve the targets and showing that everything is going favorable. So this just an example. When you tell your employees that how much time a task is going to take, they'll always tell you a higher time. So if a task requires 2 hours, they'll tell you it is going to take probably 5 hours. And then what you do is you bargain to a certain extent and you reduce the time to 3:30. Right? That's what happens whenever you go to a shop and you start bargaining, the other one is always going to quote a higher price for you. Right? So you need to understand as to why you ended up estimating 100 and you ultimately had 102. Was there a possibility that this 102 could go up to 105? Did you miss on this opportunity as well? For every variance, an analysis needs to be done. And there is volume variance, which basically says actual quantity minus standard quantity, or you can call it as budgeted quantity. It's or standard quantity. So this would be standard quantity sold, actual quantity sold, because we're talking about sales. And then as we decided that once the price variance is separated, everything gets multiplied by standard price. Once the price variance is separated, everything will get multiplied by the standard selling price this time. The actual quantity was 1000. And then what was the budgeted quantity? The question is, what was the standard quantity? Do you have any idea on this?
Sir, actual price is 102,000 divided by 1,000. So it will come 1,020. And you mentioned 102.
No, so this would be, so if you see this would be 102,000. That is your selling price. Oh, sorry, the value.
Divided by 100.
No, it would be 1000 units, right? So it would be,
Okay, got it.
okay. So this would be
Yes.
it's 102,000. That is your the value which you sold. And how many units did you sold? You sell 1000 units. So that becomes 102. Okay. And then what you need now is a budgeted quantity. What was the budgeted quantity which you estimated to be sold in your budget or in your estimations is something which would be reflecting in your standard data. So you have material, labor, variable, fixed, and selling price. So you don't have the actual quantity or the budgeted quantity which you decided during your budget, to be very fair. So in this question specifically, you need what was your total estimated revenue. Total estimated revenue. So you need this figure right here, which is basically you don't have. So for example, if I have a revenue in place, then I can, so for example, if the revenue estimated by me is this much, then I can calculate the quantity and all which I require. The standard quantity I can calculate by using a division, which would be divided by $100. And that is going to give me a quantity of 1000 units. This is just an hypothetical figure, guys. This is not given in the question. So ideally, this variance cannot be calculated. This variance cannot be calculated because you don't have the budgeted quantity. Or what we can do is we can put a budgeted quantity as this one. And this would be 1500. You can just put it this way. And then we have got the standard selling price. The standard selling price is $100. So $100. And then this basically would be 500 negative into 100. So this would be 1000 minus 1500. And this is going to give you 100. And whatever is the difference we have now. So this is just an hypothetical example we have taken, but this is something which you require in the question. And there is one more catch in the question. with respect to the hours. So whenever it is direct labor and variable labor or like a variable overheads, just make sure that the hours which are given to you are same, because that's kind of a primary requirement of a question. So for a labor and overheads, what is going to happen is this rate is only going to change and nothing else. And that same rate is going to make a difference in your variances. So if you see this, it should always be like this. How could a per unit change the parameter of per? How could a parameter for per unit change? It won't change. So that's why whenever there is a requirement that how many hours are required for a unit, either you take for direct labor, either you take for variable overheads, anything you can take, because it would be same. So for example, if this is not given to you in the question, if this is not given to you in the question, okay, this is not given in the question, and you still need to calculate the fixed overhead rates and you need the hours, you can always take these hours. You can always take that, because ideally all the hours required for one unit would be same. Only the difference would be created by the rate which we are paying them. So this is the question on the variance analysis, which would require your interpretation at a later stage. And that is something which you need just keep on analyzing it. There are two more variances in your material part, which is your mix variances and yield variances. For FMAA, I guess these are not there. But for CMA, these are there. But what information you need for these variances is already given to you in your original variances. So the only thing which you need is to calculate the mix. And for the mix, you always require multiple products. So why we didn't calculate it here is because if you see how many products is the company making, based on the information, we can conclude that the company is making only one product. And that's why there is no mix. And if there is no mix, the yield would always be equal to the usage. If there are multiple products, there would be a ratio which would be given to you. So for example, let's quickly take a hypothetical example. So the standard quantity, for example, so if you want to do a material part of it. So standard quantity for material A, B, and C is, say, for example, 100, 200, and 300. Let's just make it, let's make it 400, 200, 6, and this is, okay, let's take another one. This is kind of your standard mix, which you have estimated that, okay, this would be the ratio which you would be using. So for every one quantity of finished product, you require 400 kgs of raw material A, 200 of B, 300 of C, and 100 of A, or 100 of D. And now what is going to happen is you have actual quantity available with you. This would be your actual, so you put in the actual quantity. So actual quantity you used, it was 500. This was, say, 150, 380, and say 218, for example. So what happened was, this was your standard quantity, this is your actual quantity. This is going to give you your usage variance directly. So standard minus actual. So this would be your usage, which is standard minus actual. So this is kind of a difference in the usage you have. This is something which you already have calculated above. So this is basically equivalent to the one which you calculated right here. What I'm talking about is I'm talking about this one, the usage part. So it's standard minus actual, standard minus actual. And then what you do is you have got your standard rate as well for each one. So let's assume that standard rate is given to you in the question as like 10, 12, 14, and 16. And then what you do is you calculate your variance based on this multiplication. So that is something which you do, which you have already done. Then this is your kind of a cumulative variance you have. But now when it comes to usage or kind of a mixed variance, what you need is that you don't need this standard quantity as your reference. You don't need this. You don't need this. What you need is the ratio of this. So what you're going to do is you're not going to take these quantities as it is. You're only going to take the ratio. For mix, what you're going to do is you need to have a ratio. So the ratio becomes 4:2:3:1. So that's your ratio. Okay. This is your ratio. That is called the mix ratio. And then you have got actual quantity. So what you need is actual quantity divided divided in standard mix ratio. That is you need, and this is called as your revised standard quantity. This is called as your RSQ. This one is called as your RSQ. So for calculating RSQ, which is revised standard quantity, you require your actual quantity. See, if you see the formula, it says actual quantity. Do you have the actual quantity? Yes, I do have the actual quantity. And do you have the standard mix ratio? So the question is, yes, I have the standard mix ratio, which is 4:2:3:1. Now what I'm going to do is 1:2:1:0. This is my actual quantity, and this needs to be divided in the standard mix ratio. And this would be called as new standard. So what I'm going to do is, you can always do a kind of a ratio analysis right here. This is 10. So what it would be, this one divided by 10, that is your proportion. This is your kind of a proportion. Then you multiply it by 4. This is your actual kind of a standard quantity for the actual output. This one needs to be compared now. So now when you're going to calculate the mix variance now, what you are going to do, the formula still remains the same, which is standard minus actual quantity. So the formula will be standard quantity minus actual quantity. But this standard quantity which you're talking about won't be this one. This, we don't want this standard quantity now. We want the new one. So that's why we don't give it a name as standard quantity. We always calculate it as, or term it as revised standard quantity. So revised standard quantity is this. The actual quantity is this, and that's the difference. Sorry, let me just put it this way. So you have got revised standard quantity, it's RSQ, revised standard quantity minus the actual quantity. This is the usage difference again. But this usage difference is not because of the regular usage, it is because of the mix or the mix ratio which we have disturbed. So this one is standard minus actual. So this is your mixing problem. So what happened was, you were supposed to mix it in a proportion which you need, and the proportion which you basically made. And then what you do is you multiply it by the standard rate. Again, the standard rate would again be the same. And now this would be calculated as one of your variances. The difference between these is called as the mixed variances. And the same thing will apply for the yield variances as well, wherein the yield, that is the hours required for each of the material based on the actuals. The yield would again be calculated in the same way. So this is something which is a bit kind of a third level thing. Can it be calculated for materials? Sorry, can it be calculated for labors? Yes, it can be calculated. Instead of material, it would be labors. So labor A, labor B, labor C, labor D. But instead of giving these names A, B, C, D, it would be skilled labors, unskilled labors, or semi-skilled labors. So again, the logic still remains the same. So that's how you need to calculate it and analyze it as to why we are lacking on the things. So any questions, guys, you have on this? Okay, so what we'll do is we'll quickly take a break of 10 minutes, and we'll come back in 10 minutes and we'll start a new thing which is called marginal costing. Okay, guys, so let's start with a new kind of a concept, which is I hope everyone is back so that we can proceed. Yes.
Yes, sir.
Okay. So this is again a very kind of an important concept, and this is the base of your whole CMA or whole of your cost management journey. Every cost accountant or every management consultant who is basically having a expertise in costing would be doing an analysis based on these concepts. So it is very important for you guys to understand and like keep on solving the questions on it. Okay. So this concept is called as CVP analysis, which is also called as the cost, volume, and price analysis. Okay. So it's also called as the cost, volume, and price analysis. So what basically we understand by this CVP analysis is that analysis of change in cost, changes in cost due to volume and due to price. Oh, sorry, it's not price, it's profit. Sorry. So change of cost due to volume and then effect of cost and effect of change of volume on profit. So basically what is happening, what if we increase the cost, what is the impact on the profit? What if we increase the volume, what is the impact on the profit? What if we want to increase our profit, by what impact should my cost and volume be affected? Or same goes in a reverse order. For example, if I want to decrease the cost, what is the impact on my profit? What if I want to decrease the volume, what is the impact on my profit? And so on. So every element of the CVP is basically interdependent on each and every one. So the cost will check what happens to volume and profit. The volume will check what happens on cost and profit. Profit will check what happens to cost and volume. So that is something which is called as CVP analysis. Also, the CVP analysis enables a company. So it basically enables a company to find the level of sales and production. So at what point of production or at what level of sales and production the company should work, this is going to tell the management. So what is the exact level the company should be operating on? So you might have been familiar with the concepts or familiar with the term of optimum capacity. Multiple times in multiple questions or in multiple business jargons, they always tell you that, okay, be at your optimum capacity. So what do you mean? So how do you define optimum? So what is a number? What is number for it? Either in value or in units. So what exactly is the number? So that number is basically defined by CVP analysis. So the problem is that company during its budget decides that it has to be, or it has to achieve a certain kind of profit. So what if the company wants to achieve a certain profit? So company should always be aware of what is the optimum level of units it should be making in order to achieve that profit. So in the budget, you decide on what you need to achieve. In variance analysis, you decide why didn't you achieve, or why was the problem, where was the problem? Or if you had some kind of a favorable thing, why was it favorable? So you decide on kind of an after effect. But then if you want to decide and what was the optimum level you should be working on every time. That is something which is going to help you to understand, are you going to achieve your profit or not? That is something which is called as CVP analysis. So CVP analysis enables a company or helps the company to find the level of production and sales in units and dollars, so that the company should work above its break-even point always. So break-even point is a point wherein your cost equals your profit, or your income equals your expenses. So basically, you're not making an extra dollar. So you're not profitable. So all your cost equal to all your expenses. You're not earning anything. So what is that level beyond which you should not do the business? Is something which is told to you in detail by CVP analysis. So this is a method, or this is a technique which every cost management accountant does. So now what we are doing is, so there is a financial accountant, then there is a management accountant, and then there is a cost accountant. So ideally I should put it this way. So financial accountant or doing a financial analysis is also part of your CMA course, wherein you analyze each and every aspect of your balance sheet and profit and loss account, wherein you kind of give your interpretations. You need to calculate how the working capital works, or how the ratios work and all. So this is basically with respect to the financial analysis. The budgets, the variance analysis, and the CVP analysis are basically the core part of your cost management accountancy or the cost accounting. And both, when combined, will give you a management accounting perspective. So management accounting is more to do with your interpretations, judgments, and recommendations to the strategic management. So what happens is, let me just, out of the way, I'm telling you this. So in a country like UAE, wherein it is basically a tax-free zone, if you guys are aware. So UAE doesn't have a tax. They've recently introduced a small tax, which is VAT of 5%, but it is very negligible. It is only on the businesses, right? And that too, if they have a certain threshold and all, it's kind of very minimalistic tax. So because it is a tax-free zone, multiple people, they start up their own kind of consultancies, or what you call businesses, and all those fancy words. So what they need, because I have been living in the UAE, so what I've understood, that this market requires more management accountants, because the consulting business is something wherein a lot of judgment, a lot of interpretations, a lot of recommendations, a lot of strategic analysis is required. And that's why in this Middle East, there's a kind of a high demand for CPAs, CMAs, ACCAs, all those kind of professional courses. So what usually happens is, this business is basically run by like 2 or 3 people, or probably most of the time it is a single owner who calls himself as a CEO. And this CEO, because he is basically handling his own businesses, or giving his own services, and he's handling his own bunch of kind of services or businesses, he himself requires a strategic service. So these services are now kind of the things which these professionals are giving to the CEO directly. So what happens is, the CEO is going to have a strategic meeting with a CMA. So this is what he's going to do, is he's going to have a strategic meeting with the CMA, and then they are going to decide on the problems which CEO is facing to run his company. And that is kind of an interpretation thing, or a judgmental thing, or a skill which a CMA should have in future, or probably during this course. So, but when he's going to make a strategic decision right here, he also has to make sure that he is well versed with the BEP concepts, or he is well versed with the CVP analysis, because that is something which effectively gives you an edge to run a business. So for a CVP analysis, there are a few assumptions. That assumptions are pretty critical, and that is something you should always remember. This is not like a financial accounting wherein you put a debit, you put a credit, you get a journal entry, you get a balance sheet, you get a profit. No, that's not the case right here. So there is all the costs basically are fixed or variable. There is a concept called a semi-variable, but it is not that used. It is not frequently used in CVP analysis. So that is kind of a first assumption. Then the total cost will always establish a linear, or we call it as a straight relationship. Straight relationship with fixed cost and variable cost. So there is an equation which says total cost is equal to fixed cost plus variable cost into units. This is the linear equation which this CVP analysis is going to be based upon. Then the product mix which the company uses is same throughout the analysis. So we're not changing the product mix. So there is no change in the product mix. It's not like we started with like 3:2:1 product mix, and we ended up having 2:2:2 product mix. No, that is not going to happen. When you're doing a CVP analysis for a certain period, you have to make sure that your product mix is same for throughout the period. Then there is another assumption which says production equals sales. Usually when you're doing an analysis, you always take that, because if production is not equal to sales, there is another concept which we need to discuss. So if production is not equal to sales, then there is something called as constraints. So if production is not equal to sales, then constraint theory applies. And then what we are doing is we are ignoring the time value of money. We're not considering the time value of money, because that is something related to the financial concepts or the capital or the fund management concepts. Not considering that. Financials statements not required. Financial statements are not required, but what we need is a contribution statement to do our analysis. So we don't require financial statements. What if there is no financial statements? You're fine with that. But then what we need is a contribution margin statement. So how does a contribution margin statement look? It starts with sales. You reduce your variable cost. Start with sales, you reduce your variable cost, you get your contribution margin. So all the things, all the assumptions, or all the concepts are basically based on the contribution margin. From the contribution margin, you reduce your fixed cost, you get your profits. This is called as your profit. So this is called as a profit with respect to your CVP analysis. What if I am paying interest? What is my operating profit? What is my non-operating profit? What is my gross profit? What is my net? Nothing. We don't require that. What we need is sales. What we need is variable cost. What we need is a contribution margin and the fixed cost. That's it. Once you have this, you have a contribution statement in place. So the contribution statement, when analyzed as a whole, should always give you a kind of a diagram which somewhere looks like this. So on the left one, this is your revenue or the dollar figures. These are your dollar figures right here, or revenue and cost. You can call just this, you can call this as revenues and costs. That is all in terms of dollars. And these are your units. And this is your X and Y axis. So because we only have a few elements, which is fixed cost, variable cost, and sales, we can plot it in a diagram which says that the fixed cost is always constant until a certain level. So this line, which you're seeing right now, is basically your fixed cost. This is called as your fixed cost. Doesn't matter where the sales are going, doesn't matter where profits are going, doesn't matter where your variable cost is going, my fixed cost would always be constant. That's why the line is flat with respect to units. If the units are increasing, doesn't matter. If the units are decreasing, doesn't matter. The fixed cost is still the same. But then as the units starts to increase, so as the units will start increasing, the cost which starts increasing with the units is called as variable cost. This one is called as variable cost, the black line. Then a variable cost is the cost which starts to increase with respect to revenue. So this one is called as revenue. So this is kind of a revenue line. And this one, the green one, is called as, or the blue one is called as the total cost line. So total cost increases in the same proportion as your variable cost. So if you see this, these two lines are basically parallel. If you see this blue line right here versus the variable cost line, these are going to move parallelly. So the question is, what is the difference in the costs at any two levels? It's always the variable cost. Which cost creates a difference at any two levels? It's always the variable cost. So if you see, the difference would always be created by the variable cost. The fixed cost will always remain constant. And the moment my total cost line, that is the blue line, intersects my revenue line, this point is called as the break-even point. This is not your profit which you put into your financial statements. This is your break-even point. Are you breaking even? How much is your sale and how much is your total cost? Are you making money? Yes or no? That is something which CVP analysis is going to tell you. So if my sales, say for example, sales are 1,000 or 10,000, my variable cost is 4,500. That basically gives me my contribution margin as 10,000 minus 4,500. That is going to give me 5,500. Let's assume my fixed cost is 1,200. And then my ultimate profit, which is available for me, is 4,300. Now, what I need two things. So this is the value in totality. That's the kind of an absolute figure I have. But before that, what I need in a contribution statement is always a per unit price and the units. So ideally, what is going to happen? The statement is going to switch itself like this. This is your actual statement, which ideally it should look like this. So per unit or units and per unit right here, that should look like this here. For example, if I'm selling 1,000 units, the value is 10,000. So either the value would be given or the per unit would be given. It depends. Either way, we can calculate that. So 10 is my per unit price. And then what I can do is I can just drag this law to give my total cost. Right. So just make sure that you don't put a per unit for your fixed cost and profits, because fixed cost is dependent. It will change per unit every time. And this one would always be 1,000, 1,000, 1,000, and 1,000. So this is your kind of a statement. Now the question is, are you breaking even? How do you understand that you are have you break even? What are the units you need to be break even? That means what is the point? What are the number of units which you need to sell? You're already selling 1,000, fine. But then what are the units you should be selling to be break even? So there is a formula for that, which is break even point in units is equal to fixed cost, that is the total dollar fixed cost, divided by the contribution per unit. This gives you fixed cost, which is 1,200, and the contribution per unit, which is 5.5. And this is going to give you the number of units you need to produce to be break even. So this would be 1,200 divided by 5.5. That gives you number of units as 212. Sorry, 218. So if you are producing 218, because you cannot produce a partial unit, so this can be rounded off to say 219 units. So if you are producing 219 units and your fixed cost is 1,200, your profit would be 0. Okay, let's test this out if that does that make sense. So let's just copy all this. So if my number of units produced by 219 and my per unit cost still remains at 10, this would again be 219. My variable cost still remains at 4.5. This would be 219 again. This would be my difference. And okay, did I hope somewhere? The contribution margin is this one. These are hypothetical examples are incorrect. What? It's 10,000, 4,500. That gives me, okay. 1,000 units are there. 10 costs. this one. Okay, just give me a moment, guys. Okay, just want to check the example once. This is 10,000 right here. Okay. It's contribution per unit, okay, or what? Oh, sorry. It's a goof up in the multiplication. Yeah, right here. So if you're producing 219 units, or probably the exact units which we decided for, you would end up having kind of a break-even point. So if you produce 219 units based on the calculation and based on the per unit prices you have, you should end up making no profit, no loss. You're making this $4.50 is because we have not considered this as a full kind of an amount. But if you want, we can always have the full amount in place. That is going to give you kind of an answer, which is a break-even point. So what a business does is, initially, when the company starts a new project, company always has a per unit in place. And they also have the fixed commitments which they are going to make. So fixed commitments will include your rent, your interest payments, any other fixed commitments you have, like loan or rental payments with respect to your electricity, with respect to your water bills, utilities, etc. So all these things would be included in this 1200. So this is something which you should be aware of when you start a business. So when I'm going to start a business, or when a company is starting a new product, what it will do, it will have a per unit in place based on its experiences, based on its calculations, and it should always have a figure of how much is my fixed cost. Come what may, if I don't sell a penny, even if I don't sell a single product, what is the amount I'll still have to pay? That is something which company would have to estimate. And based on that estimate, company can tell, look, the moment we sell 218 products of the finished goods, we will be at profit. We will be at break even. The moment we cross 218, every one unit which you make is going to give you a profit equal to your contribution margin. So if I've produced 225 units, it is mostly equivalent to this. So if I want to multiply 5.5 multiplied by this minus this, it will be 37.5. So every single product which I am going to sell beyond my break-even point is going to give me a benefit of 5.50. Every product. So for example, if you want to tell me what is your profit if I sell 10,000 units after break even, so what I'm going to do is 10,000 units minus my break even point. These many products I'm going to sell, and on every product I get a profit of 5.5. So this would be my estimated profit. That's how, as a management consultant, you need to tell the management what happens if you sell the products of 10,000, 12,000, 15,000, 19,000, 20,000 based on the estimates. Can you directly calculate the break-even point in respect to sales? Yes, you can calculate using this. Instead of putting as a contribution margin, you need to put in as contribution ratio. So that ratio and all we'll study in the next class. But until then, this is just kind of a brief overview on how the contribution margin works. There are a lot of things wherein you can calculate what is your targeted profit, what is your targeted percentage sales, which you need to achieve a certain profit. So this is how the sales team of the company gets the targets. So you must have seen that all the sales associates or sales or marketing agents, they have a target in place. And how do they get a target? As to why do they get a target is because management already has these calculations in place. management knows that if I want a profit of an X amount, say for example, if I want a profit of 53,800, I need to sell 10,000 units so that I'll get a profit of 53,800. And that's why that's how this target is basically being defined. And now this target is going to get distributed amongst each and every sales representatives or sales agents. And also they get a commission on that once they sell the products. So that's how the process basically works. And that's how this CVP analysis is going to help you to make sure that your targets are achieved. So any questions, guys, on this? So any random questions apart from the topic? I'm happy to assist you on that. I'm done with the class. If you have any random questions, you can just tell me, or we can close up this session. Okay, so I believe there are no questions. Pooja, I'll send your EPS questions by the end of the day, so you can check it. Or probably
Oh,
if
okay.
I'm able to solve it right away, I can just check it out. But just give me some time. I'll send you the details.
Yes, sir. No
Okay.
issue.
Okay.
Thank
Thank
you,
you,
sir.
guys. Thank you, guys, for your time.